Business owners, there are 5 tax terms that you need to know so that you can be a part of the conversation. One thing that I realized as a business owner coming up is that in order to take advantage of opportunities, I needed to be inside the conversation or inside the room where the opportunities were happening. But if I didn't even understand the language, people knew that I was a newbie, and no one will give you an opportunity when you're the new kid on the block. So I want to make sure that you are educated in these terms so you can understand what people are talking about. Number 1, revenue. What is revenue? Revenue is the gross amount of money that your business is making. It's not the money that you put into the business. It's not the amount of a loan that is in your business. Revenue means you've actually have sold a product, you've actually serviced a customer, and you've made revenue or income. Now, make sure you realize revenue is money coming in is the same as income, money coming in. So when someone says, are you in revenues yet? That means, have you made any money at doing what it is that you want to do? Earned income. That's another important term for you to understand. Earned income is revenue coming in, less expenses. Earned income is hit with self-employment tax. That's different from taxable income. I don't want you to confuse the two. Earned income purely means this is income that I'm gonna have to pay Social Security tax on and Medicare tax. That 15.3% that you've heard me talk about, that's earned income. Different from taxable income. Taxable income means all the income that flows on your tax return. It could be from wages, it could be from your business profits, it could be from your real estate, it could be from the fact that you took money out of a retirement account. That all nets down to your taxable income. And your taxable income is typically the income that a lender is gonna look at when it's time for you to get a loan. I could be, for example, a real estate investor. All of my money can be coming in from real estate. Real estate, if I am a landlord and I have rental properties and I have tenants paying me rent, real estate then is passive. It's not going to be subject to self-employment tax. Therefore, it's not considered earned income. But we know I could be making $200,000, $300,000, $500,000 a year off of real estate. It's going to be subject to income taxes, and that's the money that the lender is going to be looking at how much taxable income I have. So make sure you understand the distinction between earned income and taxable income. For the majority of us, we really want to try to keep our taxable income down as low as possible, but we may need our earned income up to pay into Social Security and to pay into Medicare. That's why it's so important to plan out where we are in life and what taxes we're going to be paying. Another term that I want you to understand, and this is mission critical. As business owners, when you are ready to file your income taxes, you have to understand filing status. When you're talking about filing statuses, you're single, meaning that you're gonna file a tax return as a single individual. That means that no one else is going to be on your tax return like a spouse. Head of household is another filing status, and that means that I'm going to have a minor child on my tax return that I am spending 50% of support on that particular kid. That means you're gonna file head of household. You're a single individual with a minor child. You could also be married filing joint. That means that me and our spouse are gonna combine our incomes on a tax return and file jointly. You could also be married filing separate. This is where I say, I'm not filing with you. I'm married to you, but I am going to file separately. And you might want to do that for a lot of different financial reasons. But married filing separate is one of the highest tax brackets, but you're separating out your income typically from your spouse's income. With the exception of community property states, you may have to share income. And then the other filing status is a qualifying widower, where you actually had a spouse that's deceased and you had a minor child that you're going to be filing a tax return with. Understanding filing statuses is important because that plays a role in how much you're going to pay in income taxes. It also plays a role if you are filing for a divorce. Who gets to claim the kids for certain deductions? For head of household, be smart, negotiate. Another term is tax deduction. Well, a tax deduction is the same as a write-off. It means you can deduct something against your income. That's a tax deduction. That means if I'm making $1,000 and I have a tax deduction of $100, I can deduct that $100 from my $1,000 to get my taxable income down. Many people take a lot of tax deductions, and the wealthy people take a ton of tax deductions because they understand tax deduction. We gotta get ourselves educated if we wanna come up. So many of us are working so hard in our businesses, but we're not putting more money in our pocket. Why? Because we lack the education needed to get over the hump. So you got to start educating yourself, and you cannot wait for your tax person to educate you. They are not responsible for your financial success, your education, your financial literacy. You have to make it your business as a business owner to educate yourself financially, because that's when you're going to see your business go up to the next level. Itemized deduction. This is another terminology that you need to understand, because this is different than deductions. As a business owner, we're taking deductions from our income. We are writing off the cost of operating our vehicles. We're writing off the cost of our rent for our offices. But itemized deductions don't have anything to do with being a business owner. This is all about being on your personal income tax return and writing off things like charitable contributions, writing off things like our state income tax, writing off our mortgage interest. This is where itemized deductions come into play versus a standard deduction. Anybody can take a standard deduction because our government says that every taxpayer gets to take a standard deduction, meaning if income is up here, we're going to give you so much to deduct from your income. But it's very little in comparison to somebody that is itemizing deduction. So just imagine if you are paying $3,000 a month in rent. If you turn that rent into mortgage interest, that would be $36,000 compared to maybe $12,900 as a standard deduction. So if you can get yourself in a position to be able to itemize your deductions, you are going to see lower taxable income. And at the end of the day, as a business owner, we have to pay all of our own taxes. We don't have an employer behind us withholding on our behalf. We don't have an employer paying half of our self-employment tax. It's so important that we as business owners master the tax terminology so that we can increase the amount of cash in our pocket, so that we can increase the amount of opportunities that we can get involved in to make more money and get access to those rooms and those people, because they're talking up here and our level of education is down here. We got to rise up and get our financial literacy up so that we can really start to parlay more. Many of you may think, oh, if I sell more or do more in my business, I'm going to make more. There's going to come a time in your business that selling more is not going to put more money in your pocket. You got to educate yourself more and understand what wealthy people do to keep cash in their pocket. And part of what they do is they are educated about finances. That's why it's important for you to get your financial literacy up. I'm glad you are. And that is why it's also important for you to like, comment, and subscribe so I can keep you updated on all things tax and business, because it's all about your money in your pocket.